you have a university course on Bitcoin now. Tell me about that.
Well, I guess like the basic idea behind this was I've been writing about it for at least 10 years. And it's probably the most frequent thing that students ask me about. I get a lot of students who show up in my office and just want to ask me questions about Bitcoin. And even students that are not my students, just random students kind of pop in and say, "Hey, I noticed that you study this. Like, I want to ask you some questions." And so that's kind of a lot of fun. Um, so I kind of just got the idea that like maybe I should just put together an actual course on this. And then it was also motivated by the fact that like I what attracted me to Bitcoin in the first place was that I saw a lot of lessons from traditional monetary economics that could be applied to Bitcoin, and that Bitcoin was sort of like a test case of a lot of open questions that we kind of talk about in monetary theory, and also that most monetary theory is kind of informed by historical experience. And so this wasn't something that was in the historical experience, and so there's a potential opportunity here, right, to test the theory. Is the theory good at explaining things that didn't come before it? Or is there a flaw in the theory? Is there something that we need to think about? And so like all of those issues kind of fascinated me. But I think a lot of people in the economics profession had the complete opposite take on this, which was just like, this is dumb, this is a fad, this is some stupid like libertarian like attempt at creating money or something like that. And they were just incredibly dismissive of it. And so I really felt like, given the demand from students to kind of learn about this stuff, and given my belief that there's actually a lot of there are actually like a lot of interesting questions to ask and answer about Bitcoin just from what we know in traditional monetary theory, I just felt like maybe I should organize all of that stuff into a class, and then kind of get people to realize that, hey, you can take this seriously, but you can also be critical about it. You can also look at how Bitcoin works, and you can apply that to monetary theory, and then make predictions about what you think is going to happen in the future. And I think that that's really useful, and I think that it's much more constructive than the people who just constantly go out there and say, hey, this is a waste of time, this is a waste of resources,
Yeah.
it's going to zero, like all these things that people say for years and years and years. It's much more interesting to actually study it.
Yeah, it's so interesting that you'd say it's actually, from your perspective, an interesting way to test economic theory and to see, okay, there is this kind of new private money, perhaps. What does traditional economic theory say about that? How does that change things? And so you kind of think maybe economists should be interested in that. And so was it like in your actually, I don't know if you've actually started teaching it now. Was that difficult to implement? Like, because sometimes, as you say, for a lot of economists kind of think, I don't is this really something very interesting? Is this just a fad?
So I'm in the middle of teaching the class right now. The way I structured the class is I actually started like I basically just have the course is divided into two halves. Now, of course, like there's little subunits inside those halves, but basically the idea is like the first half is like, let's actually just talk purely about monetary theory and some monetary history. So let's look at, what does monetary theory say? What's our historical experience with different types of money? And to just kind of go through all of those things and think, okay, what do we know, or what do we think we know, and what lessons have we learned, that kind of thing. And then the second half of the class is then, okay, what is Bitcoin? Like, how does it work? Where did it come from? Like, why was it designed? What were the precursors to Bitcoin? Like, why were people, because I think that's one of the things that people kind of discount, is like, this isn't just like some random guy just, woke up one day and was like, hey, I've got this idea, right? Like, Bitcoin actually sort of emerged out of this process where people were trying to figure out, hey, as we move more and more towards a digital world, like we're going to need some kind of like electronic version of cash. And we don't have anything like that. And so there was really this kind of push to think about that and to kind of develop something like that. So talking a lot about that history, talking a lot about then the introduction of Bitcoin, how it works. And then once the students have a sense of, the background and sort of how it works, then it's like, okay, now let's go back, right? So you learned all this monetary theory, you learned all this monetary history. Now you've been introduced to Bitcoin. Now you know where it came from, you know how it works. So given that, like let's now apply these lessons from monetary theory to Bitcoin itself.
So it's interesting you'd say that there's this kind of innovation, right? You might want to try and make a cash that you can send over the internet, but would you say it's then a difficult thing to do, and so it's an interesting solution that Bitcoin has to find in order to be able to solve that? Like, tell me a bit about that problem. Why is Bitcoin interesting from that perspective?
Yeah, so the basic idea is like if you think about cash transactions, right? Cash is really private. Like if you and I engage in a cash transaction, we're the only two people who know that the transaction took place. There's nobody who has to approve the transaction. There's nobody who's keeping a record of what you gave to me in exchange for the cash. And so one of the things that people were really concerned about is that as we moved more and more towards this digital world where, you know, more and more people are just using debit cards instead of cash. More and more people are having to use debit cards or credit cards because they're making internet transactions. That in a world where that takes place, and in a world where all of these records are sort of stored on some server somewhere, that's really a risk to a lot of people in terms of their privacy, right? So your personal information could be leaked, your transaction history can be leaked, even if that stuff isn't leaked or hacked or whatever. Also, like your bank has unprecedented access to like what you are spending your money on, where you're spending your money. So all of those things are things that are really new in a digital world, right? This is not something that people really had to worry about, 100 years ago, right? And so people are incredibly concerned with that problem. And so they started saying, well, basically, the only solution is that as we go into this digital world, you're going to have to create some kind of electronic version of cash. And maybe that doesn't sound difficult, right, when you just say it out loud, but it turns out to be incredibly difficult because one of the things that makes it difficult is that you've got with physical cash, the reason that you don't need an intermediary is there's like a literal physical object that you can just hand to somebody else. And so cash is sort of like a record keeping device, right? Like, so I go to the grocery store and I say, hey, I want to buy a ribeye, right? The guy behind the counter is like, well, why should I give you that ribeye? And I say, well, I just taught classes last week and, that was really valuable for the students. And the guy says, prove it. And then I, pull, some money out of my pocket and I hand it to the guy. And then he's like, oh, okay. And then he sells me the ribeye, right? Like it's a record keeping device. It's sort of keeping track of, value for value. Like I'm giving, when I'm providing a good or a service, like to somebody else, they're giving me money. And then that cash, sort of keeps a record of that transaction. But in a digital world, you still have to you have to track ownership, and the only way to track ownership is to track these transactions. And it turns out that that's really hard to do without some third party involved, right? Because the way that we typically do this is, we engage in electronic transactions all the time, but we're using our bank. So, I can send you money, but what's going to happen is that if I send you, money from my bank knows of that transaction, right? They're making sure I have that amount of money in my account, and then they're sending it to your bank, right? And so there are all of these trusted third parties involved. And so if you try to create an electronic version of cash, one of the issues here is that you've got to have some kind of ledger that's keeping track of balances but typically a ledger has to be maintained by somebody, right? And but if it's maintained by somebody, then that's not a cash-like transaction. You've just reinvented a bank, right? And so the idea is like you got to figure out a way where you could have a ledger, but there's not like a single third party that is operating that ledger. That turns out to be an incredibly difficult problem, because what it requires decentralization. You've got to have lots of people maintaining a ledger, and then there's a very there's a very important problem here, is that you might say, well, this is really easy. You just have a bunch of people manage the ledger. Everybody just updates and go. But then the problem is then there's a question of consensus, because yeah, everybody can maintain a copy of the ledger, but how are they going to agree on what the ledger says? And so in game theory, there's sort of a famous kind of problem, which is like the Byzantine generals problem. So the idea is you got a bunch of generals, they're surrounding a city, and if they all attack the city simultaneously, they'll conquer the city and they'll take the city. But if any of them don't attack, then the attack will fail. Well, the issue is like, how do you get all of the generals to agree on the precise time to attack? Like, how do you get them all coordinate on that same exact time? And that's the problem you face when you're trying to do this decentralization with electronic cash. Is sure, you can have a bunch of people maintain the ledger, but how do you get them all to actually agree on what the ledger says and to agree on all of the updates to the ledger?
Right. And so when you think about Bitcoin as a kind of a cash-like alternative for in a digital kind of world, and we don't have to go into sort of we could, but into the how it does that in terms of trying to create a kind of ledger that isn't just everyone holds it, because otherwise there's kind of no point. That how do we all agree? But equally, if it's just a one party looking at it, that's the whole point thing we're trying to sort of get around, is how we kind of have some more greater privacy and have something that's more cash-like. So would you say that now Bitcoin is quite private? Tell me about, in practice, how much anonymity can be maintained. I mean, and is that one of the benefits, selling points of Bitcoin, do you think?
Well, I mean, it can be potentially very private in this but you have to sort of live on Bitcoin, right? So if I'm just living in a Bitcoin economy, right, where I'm just like where I'm getting paid in Bitcoin and then I'm buying things with Bitcoin, there's no real way to identify who I am. I'm engaged in peer-to-peer transactions. There's not really any way to identify me. Now, in the current world, it's not really that anonymous, because in order to use Bitcoin, most people are using on and off ramps from Bitcoin, right? So if you receive Bitcoin and then you decide you want to buy something, there are a lot of people who won't take Bitcoin in exchange for whatever good or service they're providing. In which case, if you want to spend that Bitcoin, you first have to sell it for your own domestic currency, and then use your own domestic currency to purchase the goods. Well, doing that requires interacting with a trusted third party. So now you've got to you've got to go through some company. So in the United States is like Coinbase or like River or these kinds of companies that provide these services. But so the thing is, though, is like, okay, suppose you've got your Bitcoin, you need to turn it into dollars. You send that to Coinbase, you sell it to Coinbase, you get dollars back, then you take those dollars, you put them back in your bank account. Well, now the address that you sent that Bitcoin from is now linked to your identity. And so, and because Bitcoin is a public ledger, then you can take that address and you can track, where, you can track every address to which the Bitcoin came from. And so if everybody's kind of doing this and everybody's interacting with these like third-party off-ramps and things like that, then at the same time, what's happening is that you have, you could potentially start to link different addresses to different people, and then the more addresses you can link to people, then the more the ledger becomes less private, right? Because you can kind of identify these things. And also on the other side, like there's the issue of, how do you acquire Bitcoin? Most people today are probably acquiring Bitcoin through some kind of exchange, right? So they're getting onto River or they're getting onto Coinbase and they're buying Bitcoin. And then, yes, they might send it to their own Bitcoin wallet. And so, but that initial transaction links that Bitcoin address to your account with this company. And so now subsequent transactions are much harder to figure out, because if you send Bitcoin from that address to another Bitcoin address, well, it could be another of your own Bitcoin addresses. It could be you sent it to some other person. So it's a little bit harder to track going forward than it is going backwards. But that also kind of depends on whether or not people are giving out their information through these on and off ramps, right? And if they're able to be identified. But, at the same time, this is one reason why, Bitcoiners argue that, like, you should never use an address twice, right? That, like, you should never try to receive Bitcoin to the same address, because it's all based on public-private key cryptography. And so your private key can be associated with lots and lots of different addresses. And so the idea is that, like, well, you just want it to be, you want to use a different address every time you receive Bitcoin, because if you're always receiving it to the same address, well, then that's another way that people can identify that, oh, hey, that's you, right? Like we know that that's you.
I see. So within your own private keys, there are ways to kind of make it a bit less obvious that it's all the same person. I mean, it makes sense, right? So if you just use Bitcoin, then yeah, it's private. But obviously, if you then start interacting with the third parties who are overseeing lots of transactions, I mean, that's the whole. Yeah, then if you do that, obviously, then those people see it, and then that sort of defeats the purpose in the way, if that's what you want out of Bitcoin, is privacy. And that, yeah, I in trying to think about the impact that Bitcoin has had and will have, I'm then trying to kind of go from here to what degree will it be used as money, and can it be used as money, like, exclusively, let's say, and we talked about, for example, perhaps you have Bitcoin, it's useful, but then there's some people that don't accept it. And tell me about the feasibility of that.
Well, so I think maybe I would go back a bit and say that, like, to me, there's two innovations in Bitcoin. So the first thing is that it solves this Byzantine generals problem, and so it has this proof of work consensus mechanism where you're basically, in order to add a new block of transactions to the ledger, you have these people who are engaged in, what's commonly referred to as Bitcoin mining. But basically, all this is just like guessing numbers and passing them through. This is really just taking information about the block of transactions, and then on top of that, using this nonce, this number that you include alongside that information, and you're just guessing different versions of the number, and then passing all of that information through a cryptographic hash function. And what this requires is that what comes out of that cryptographic hash function is just it's just basically like a long series of numbers and letters, right? And so and so the idea, though, is that in order for you to find a quote unquote valid hash, that hash that's coming out of that function has to begin with a certain number of zeros. Okay. And so why is that important? Well, it's important because the people who are engaging in Bitcoin mining, it's impossible to find a valid hash other than through brute force, like just guessing numbers and keep feeding them through the function. But at the same time, it's extremely easy to verify. So once I say, hey, I've got a valid hash, everybody else can take the exact same information from my transaction block, along with my nonce, pass that through the hash function, and they will get the hash that I got, and they will say, oh, yeah, he found a valid hash. And so that block gets added to the ledger, and then people start working on the next block. And so, in other words, it's this cryptographic hash function that's really like key here, because it's sort of impossible to go backwards. It's a one-way function, right? So there's no way to reverse engineer a solution. So it's very, very difficult to find a valid hash, but it's very, very easy to validate that this is a valid hash, right? To verify that this is a valid hash. So, so this solves the Byzantine generals problem, because this is how people are able to coordinate, right? They wait for somebody to find this valid hash, and then once they do, it's easy to recognize, and so everybody updates and then moves on to the next block. So that's the sort of technological innovation, is that all previous attempts at doing electronic cash couldn't solve this problem. But that proof of work mechanism is actually what solves it. But then there's also an economic problem that it solves, right? So the economic problem that it solves is that when you think about monetary theory, the biggest problem with introducing a new type of money is that it's subject to the last period problem, right? And so the basic idea is that if at some point in the future people will stop taking this as money, well, then the day before they stop accepting it, you should stop accepting it. But if you're going to stop accepting it the day before, then other people are going to stop taking it the day before that, right? And so through backward induction, you just shouldn't accept it now. So the last period problem is like, hey, eventually this stuff might be useless, and so I don't want to accept this thing because I don't know how long that's gonna last. And this is why like early forms of money were things like gold and silver, because like if there's ever a point where like, oh, people won't take gold coins anymore, well, so what? You've just left holding a bunch of gold, which has value, and you can sell that and you can use that to get what you want.
So there you're saying, with like someone trying to release a private money that has, say like fiat notes or something, which you're trying to say you believe in this value because we're going to be a bank, we're going to be issuing this money, but then why should we trust this? Why should we believe that this is still going to have value? Right. So this is why people may revert to gold and things, which the method itself has a value.
Yeah, and so kind of like there was this paper in the 70s by Ben Klein, who was like, well, could you actually have like a competitive like fiat money system, right? And so like this was really driven out of the fact that like this was written in the 70s. There were a lot of papers that came out around the same time. They were all getting at the same issue, which was essentially like, hey, the central banks seem to be doing a bad job. Inflation's kind of out of control. Like are there alternatives to this? And most people were like, oh yeah, like we could have like a competitive system, but they were referring to like historical accounts. Like what was interesting about Klein's paper is he considered a hypothetical world. Like what if we just let all banks just issue their own notes, but like they're not redeemable for anything. Like everybody's just issuing their own dollar notes or whatever. And it was just a kind of like a thought experiment more than anything else. It was like, could this sort of situation survive? And the lesson from Klein's paper is it essentially all comes down to one thing, is that if a bank actually had the ability to like just issue their own money and it's not redeemable for anything else, they have an incentive to invest in the brand name of their money. So they have an incentive to actually invest in reputation and convince people that they're trustworthy, because that's what's going to allow them to generate profit. However, there's always this chance that after you've established that reputation, after your balance sheet gets sufficiently large, that you could secretly just print up a bunch of money, go out, spend that money, buy a bunch of stuff before anybody realizes it, and then by the time people realize the amount of money that's in circulation, the purchasing power plummets and it's gone. But by the time they figure that out, you've already got all this wealth. So like you basically just transfer a bunch of wealth from people who are willing to accept your money, and you get real goods, and now they get those worthless pieces of paper. And so what Klein's model really boils down to is he says, look, you would have banks behaving honestly as long as the present discounted value of future profits is greater than that one-time wealth transfer. Right. And so as long as like behaving honestly is going to get you greater profits, like you don't have an incentive to do that one-time wealth transfer. But if you do have the incentive to do that one-time wealth transfer, then at some point in the future, so then you're just solving an optimal stopping problem, right? You're just waiting for the right time to secretly print up a bunch of money. And so what Klein's, like an implication of Klein's model is that, well, a bank could signal that they're trustworthy by committing to like limits on the supply of their currency. But of course, the problem is then you've got this trusted third party again, right? Where it's like, well, yeah, you can commit, but like, can I trust that you can actually keep the commitment, right? So, anybody can make a promise. It's like the keeping of the promise, right? That's the difficult part. And so that's the economic innovation of Bitcoin, is that embedded in Bitcoin's code is this idea that, like Bitcoin, there can only be 21 million Bitcoin. And so the supply of Bitcoin is fixed. And so since the supply is fixed, that is actually the commitment that Klein is talking about. But unlike in Klein's model, where you're thinking about banks issuing money, in the case of Bitcoin, you don't have to trust anybody because it's in the code. And people say, oh, well, people can modify the code. Well, not really, because since everybody's maintaining a copy of the ledger, everybody has to be, like, the people who are maintaining a copy of the ledger, they're running the Bitcoin protocol. Bitcoin protocol is what allows them to have that copy of the ledger. But you choose what version of the protocol that you want to run. And so, yeah, yes, the code is open source. Anybody can go and create their own version of Bitcoin where they just increase the amount of Bitcoin and say, hey, you guys should all run this. But if nobody runs it, then it doesn't matter. And so then you can think about the economic incentives involved. And if you think about the economic incentives involved, like, nobody who's actually running the Bitcoin protocol would ever have an incentive to run a version where the supply of Bitcoin is even greater than it is now, because conceivably, if you're running the Bitcoin protocol, you probably own Bitcoin. And if you own Bitcoin and then you double the supply, well, then you have the value of the existing Bitcoin that you have, right? So you don't have a financial incentive to run that new version of the code. And so we don't have to rely on trusted third parties, because nobody actually has the incentive to create more Bitcoin in the way that banks do in Klein's model. So I think that's the fundamental thing, is that you have this technical problem, which is how do we get everybody to coordinate, which Bitcoin solves. And then you have this economic problem, which is how do we get the issuer to commit to some kind of quantity restriction, which Bitcoin again solves by putting it in the code and aligning the incentives of the people running the code with the code itself. And so that's kind of innovation. Okay, so to get to your broader question, is that the market will decide what the value of that innovation is, right? So but I think that's the right framing, is to say, look, there's a technological and there's an economic innovation here, and then that innovation is potentially valuable, but then the market will have to kind of decide what the value of those innovations actually are.
Right, so it can solve this problem kind of posed many decades ago, as you kind of say there, that, well, how would you get a private money? And it kind of boils down to, can you commit to not increasing the supply? And then with Bitcoin, no one really has an incentive to increase the supply, and anyway, I mean, everyone would have to agree to it, and it's like, you can just make your own kind of version of Bitcoin, but then who cares? It's a kind of, there's a ledger that everyone's used, that everyone has, and it's and as you said, the Byzantine general's problem as well, right? So it has these technological innovations. I mean, do you think so? Like, central banks at the moment, I guess they are entities which release, they can release this kind of money that isn't at least not now redeemable for, say, gold, for some commodity. And that's why I was kind of thinking about, then almost to what degree does Bitcoin not compete, but like, what is it in relation then to central banks? Because, like, why are central banks able to do what they do, releasing money that people accept and use, which is not redeemable for something?
Well, I would say there's a couple of reasons. So why are they able to sort of get away with this last period problem? I would say that, well, on the one hand, all you really need for money to have some kind of money circulate is a network effect, right? So I will accept dollars from you as long as I think that I'll be able to spend those dollars somewhere else, right? And so the one way that central banks have been able to get away with this is that with fiat money, they didn't just introduce it sort of out of nowhere, right? They introduced, this was sort of a gradual process of sort of altering monetary institutions over time. So, if you in the United States, if you go back, 120 years or so, right, you had individual banks issuing their own notes that were redeemable for gold. But then along comes the Federal Reserve, and so then the Federal Reserve becomes the exclusive producer of these banknotes, which are still redeemable for gold, but now they're not, issued by the individual banks. And then finally, when the United States sort of suspended convertibility in the Bretton Woods system, it detached any kind of connection of the dollar to gold. But the network effect is already there, right? Everybody's already using dollars. And so the network effect isn't necessarily going to break down because, everybody's already using them. We already expect everybody else to use them. So there's not necessarily an incentive for everybody to just go, well, this is worthless, and just kind of move on, right? So in other words, central banks kind of benefit from the fact that like they're able to issue fiat money because of this sort of path dependence. But I would say that like it's not actually clear that they've solved the last period problem. In fact, I would argue that they haven't solved the last period problem. If you look at virtually any money, or excuse me, any model of fiat money, there are two different equilibria in those models. In one, in one equilibrium, money has positive value, and in another equilibrium, it's worthless. And not only that, but like if you get a large enough shock to the economy, it can push you out of that equilibrium where it has positive value, and you can very quickly move to the equilibrium where it has zero value. We call that hyperinflation, right? And so what happened, and one of the ways that you could think about this is like this is where the last period problem rears its ugly head, is that if you have a large enough shock, it undermines people's confidence that people are going to accept this stuff in the future, or at least that they're going to accept it, for an expected amount of goods and services. And so people try to get rid of it faster and faster and faster. And that just further depreciates the value. And it almost becomes a self-fulfilling prophecy, right? That like, you're like, oh, this money is worthless, I got to get rid of it. And then, but then everybody's doing the same thing. And then the money does become worthless in terms of purchasing power. So it's not clear that they've actually solved it. Like when you look around the world, there are lots of examples of, hyperinflation. There's lots of examples of where people have to do some kind of currency reform or something like that to reintroduce a new, their currency, or to introduce a new form of currency, or redenominate their currency. All of these kinds of things. And the thing is that even those plans, like when you see countries do those things where they say, oh, hey, like that was a disaster. Okay, we're going to issue this new currency now. Things are going to be different. The only time that those things ever work is when they tie that currency to something else, right? So they have like a currency board, or they make it redeemable for dollars or something like that. So in other words, fiat money, can't solve that problem. It benefits from path dependence, and then it benefits from the fact that as long as you don't have these large shocks, that path dependence can continue. But if you have this large shock, you can get hyperinflation. And then if you try to reintroduce money, you're going to have to tie it to something in the real world that people are willing to accept in order to convince people to accept the thing that you're introducing.
Right. So that great. It doesn't actually solve the problem, right? So historically speaking, there are people, I think, say in the case of the US and Europe, it was a kind of gold standard, and the people accepting that, and then so it's kind of because it moved onto fiat money, and it makes a lot of sense, right? You see a lot of countries when they have hyperinflation or some kind of problem with their currency, no one does kind of trust them again. So you actually do see exactly what you'd expect play out, which is that they've kind of had the so when hyperinflation occurs, what are the incentives for, like, when a shock occurs? Why would one want to induce hyperinflation?
Well, so there's a variety of reasons here. So like in developing countries, I mean, one problem is that like they actually just lack, they lack the tax infrastructure, right? Like they don't have a well-developed bureaucracy that can collect a lot of taxes. And so if they're subject to some kind of significant shock to their economy, and the government has to spend a lot of money, it's like, well, where does it get the money? Well, a lot of times it just kind of starts printing the money to pay for things. So you have instances like that. You also have instances where like the fiscal side of policy is just irresponsible, right? Like so you see, sovereign debt levels get way too high, And then what happens is like it's not even necessarily that the government is sort of making a conscious choice to hyperinflate. It's just that, it's just that there's this sort of self-fulfilling prophecy there, right? People are like, oh, we don't think that you're actually going to pay back this debt, and so everybody starts selling the debt. And as everybody starts selling the debt, like a lot of times, like the central bank will step in and say, hey, we got to stabilize these markets, and they've got to be sort of the buyer of last resort for that debt. But then as they're doing that, they're effectively just monetizing all of this debt, which leads to inflation, right? And so when we think about large shocks, like the large shocks, a lot of times are fiscal shocks, right? And when those fiscal shocks occur, that sort of disrupts this equilibrium.
Right. They need money from somewhere, and that can be, and many different kinds of economic shocks and circumstances can lead to this. I mean, one thing I wanted to talk to you about was, because we talked about how Bitcoin has this limited supply, then, we often think about central banks, both, monetary policy and fiscal policy, as being able to stabilize the economy. And I don't know if this is exactly your field of expertise, but I'm wondering, to what degree is that necessary? Do we lose out on the ability to change the money supply? Like, to what degree is changing the money supply necessary? For example, like we often talk about, we need a certain level of inflation that's helpful for the economy. Otherwise, high levels of inflation or deflation can kind of spiral. Like, tell me a bit about what you think about this.
So I've never bought the argument that like we need some, positive rate of inflation. That's never really made sense to me. I think that actually what that's entirely driven by is that we had the deflationary experience of the Great Depression, and it convinced people that deflation was really bad. And so they wanted to avoid deflation. And I think that, having positive rates of inflation prevents the sort of negative shocks that lead to deflation. I think that's really the argument. I don't think that actually, if you look at the economics literature, there's not a lot of literature on optimal monetary policy that suggests you should have a positive inflation rate. In fact, there was a survey that came out, years ago that essentially found that like the vast majority of papers on optimal monetary policy of like to say that like the last 25 years or something said that like the optimal rate of inflation was like less than or equal to zero. And so I don't buy that argument. Then the other thing is like the thing about monetary policy is really fascinating, because there is a great line about this in a book called The Theory of Money by Jörg Nihans. So Jörg Nihans was a great underrated economist, and his point in the book was he has a chapter on commodity money, and he talks about commodity money, and he kind of talks about how there are lots of critics of commodity money, and he points out that like, look, the critics are correct that in theory, if you had a central bank that could manage the money supply, you could actually outperform the gold standard, because you could get the sort of long run price stability provided by the gold standard without the short term price instability caused by various shocks under the gold standard. But his point is that, well, yeah, in theory, like you can get that. The question is, do you actually get that in practice? So like, do central banks actually do a better job of maintaining that like long run or price stability even in the short run, right? Do those central banks, and so part of that is like, do they do a good job about smoothing out business cycles? I would argue that the answer is actually no, right? Like, even when you see people who present evidence about this, like one of the funniest things that they kind of do is they say, well, if you ignore the Great Depression, like the Federal Reserve has done a great job. Well, okay, yeah, I mean, I don't, I don't, like, I mean, if you ignore the, if you ignore the killing, the murderer doesn't go to jail, right? I don't really understand like the logic of that, right? If you ignore the worst thing that we've done, like we're actually doing great. I don't know that that's a good argument. I also think that as time goes by, it gets harder to make that argument, because like when you were making that argument in say like the 1990s or the early 2000s, it certainly looked like, other than the Great Depression, the Federal Reserve had done a pretty good, and the Great Inflation, right? That the Federal Reserve had done a fairly good job, right? Especially like post Paul Volcker, right? So Paul Volcker brought down inflation in the U.S. And so then you had the Volcker years and the Greenspan years, and then and that seemed like a sort of new era, right? Like monetary policy kind of figured things out, and maybe things were more stable. Since then, I think that like it's been a dramatic disaster, right? Like we had the financial crisis, and the Federal Reserve just did some of the most bizarre things during the financial crisis. I think that when you look at how they performed during the financial crisis, I don't know how you don't see that as a failure. Also, even like coming out of COVID, the Federal Reserve had gotten a lot of criticism after the financial crisis because the U.S. economy didn't recover as quickly as people thought that it should. And an argument that some people were making is that, well, the Federal Reserve like sort of had claims that it has this target of 2% inflation, but actually it looks like they have a ceiling of 2% inflation, right? That they just try to keep inflation below 2%. And the argument that people were making is like that was what was holding the economy back or something. Now, I don't buy that argument. But I do think that that argument had an effect on FOMC members, because as we were coming out of COVID, you did have a lot of members of the FOMC. That's the committee that votes on monetary policy in the United States. They were saying like, hey, like we're not seeing inflation, so we don't really need to do anything about inflation. And if we do have inflation, it's probably going to be temporary. And that was colossally wrong, right? And so the thing is like when I make these arguments, I think a lot of people, especially because I have friends at the Federal Reserve, a lot of people, think that I'm making an argument about like people, but I'm not really making an argument about people. Like the argument that I'm making is that like, look, if you're consistently having these problems, if you're consistently, that actually suggests it's not an issue of people. It's not just a matter of getting the right people in place, right? Like that it suggests that like actually this is much harder than people are willing to admit. And I think there's a lot of hubris in central banking about like, oh, like it's sort of very sort of technocratic, like we can solve these problems and we just need the right people and we need all the right data and we can do these things. And I'm just fundamentally skeptical about that. And I think that historical experience bears that out, that like there are these times when you have really great people making really colossal errors. And I don't think that that's because they're bad people or they're dumb people or they're incompetent. Like I think that's just the nature of central banking. And I wish more people would realize that.
Right. Well, what strikes me is that economists, I mean, classical economics kind of thinks that we can't solve planning problems, right, of allocation of resources. I mean, there might, in the optimal planner's problem, like theoretically, it can be optimal, but how do they achieve that optimal allocation? How do you even define people's preferences and, solve a model like that? So we kind of accept that it needs to be distributed for that kind of problem. But monetary, and when we have money in the equation, then we kind of go, well, maybe, we can. So I wonder, do you think then that perhaps in, resolving more temporary, small term, controlling inflation and things, that comes at a cost of, you might have bigger shocks, and just no kind of centralized institution could really maintain and balance the money supply effectively?
I mean, I think like one of the things that has to be answered when you're talking about central banks is that, take any econ class, just any micro econ class, right? In any micro econ class, what do you learn? What you learn is that like competitive markets are better than markets with a monopoly, right? And so economists are pretty consistent on this, right? Like economists are pretty consistent that competition is better than monopoly. That there's only rare instances, like in the case of a natural monopoly, where competition could potentially make things worse, right? So overwhelmingly, they favor competition over monopoly. But then all of a sudden you talk about central banks, and then people just kind of take it for granted. Well, this is money, so of course you've got to have like a central bank that has a monopoly over currency. And it's like I don't I don't quite understand that. I mean, my frustration is not that people sort of disagree with my skepticism. My frustration is that um, they're not even entertaining this question. They don't even see the contradiction there, that like they go around talking about, the perils of monopoly and the benefits of competition, while at the same time like ignoring the fact that like they're advocating for a monopoly in this specific instance, and they're sort of just implicitly accepting that there should be a monopoly, right? It doesn't like a central bank is not a natural monopoly, right? So the the idea that that this is somehow explained by economic theory is just wrong. And so I just wish that more people would actually just wrestle with that question. That doesn't mean that everybody's going to come to the same position as me, but we should at least agree that like, hey, the starting point should be, hey, if we think competition is good everywhere else, why don't we think competition is good in currency?
Well, and that kind of gets back to, we were talking about to what degree so Bitcoin can kind of, perhaps it is in a way kind of private money, which perhaps has a lot of problems if we want to think about how it could be issued, right? If someone wants to renege on a promise of issuing this money that isn't backed by something. So, I mean, what do you think? I don't want to like then do predictions of like the future of what the central bank versus Bitcoin would look like, but I mean, would you say then that would be? Do you think we kind of have established, like we talked about it here, that it would be better if someone didn't control the money supply? Then that we don't really need this kind of movement of it. I mean, what about deflation? You talked about the Great Depression, and what is deflation really bad or?
Well, I think that's actually like the fundamental problem with all central banking. Actually, is that they sort of drew the wrong lessons from the Great Depression. Like the um, if you if you look at history, there are essentially two types of deflations, right? There is the type of deflation that's sort of driven by technological innovation. So under the gold standard, prices are pretty, over the long term, prices are pretty constant. But if you have technological innovation, actually prices on average kind of decline over time because the rest of the economy is kind of growing faster than gold production is growing, right? And so prices tend to fall over time. And if you go back to like the gold standard era, especially in places like the United States, you had long periods of like sort of modest declines in prices that didn't do any harm to the economy, that didn't provoke any kind of recession or anything like that. Um, but the second kind of deflation is sort of policy-induced deflation. So this is when you have a particular policy that causes inflation. When you have a particular policy that causes inflation, this is actually pretty harmful. And the reason is quite simple, right? Like if you think about a technologically induced deflation, what you have is you actually have rising wages and falling prices, right? So, so in that instance, like prices are falling, but your wages are rising, and so like this is providing a benefit to people, but also like this pertains to debt, right? When you have a policy-induced deflation, you tend to have falling wages or falling employment, right, and falling prices. And there, the problem is that if you think about how most people conduct business, if you think about how most people live, right, most people have a mortgage on their house. If you own a farm, like you're typically borrowing money and then paying off and then paying that off, when you sort of sell your crops. You think about a business that they're typically, they're typically being supplied some kind of credit, to engage in production, and then after the production, they're using the proceeds from that production to pay off that debt and things like that. Well, but when you're borrowing in dollar terms, right? And so if I borrow $100,000, and so let's say I'm a farmer, I borrow $100,000, and then the prices of my crops all fall. Well, now the amount of revenue that I'm going to generate is much lower, because it's not just that prices have fallen; it's that they've fallen because there's this policy-induced deflation. So people are buying less stuff, and so prices are falling. So I'm selling less at lower prices. It becomes much harder for me to pay off these loans. Whereas when you have a technologically induced deflation, um, it's not harder to pay off your loans because like prices might be going down, but if you're the farmer, your costs are also going down, right? Or if you're the worker, your wages are also going up. So like your ability to pay back these loans is not affected. In fact, like it actually might become a little easier to pay off the loans because you have a little bit extra income. But so there are those two contrasting things, and the issue about the Great Depression is that the countries that participated in World War I had all suspended the gold standard during the war to try to so that they could finance the war. And then after the war was over, they all promised to resume convertibility at the previous parity. Now, in reality, only the UK and the US actually, stuck to that promise. But when you stick to that promise, what you're basically saying is that during the war, yeah, we're going to experience some inflation, right? And that's because we've got to fight this war. We've got to spend lots of money. We got to borrow lots of money, and we're going to have to print some money, right? But when the war is over, we're going to go back, which means we're going to experience this period of deflation that's going to undo all of that inflation. And historically, that was very, very costly. Like, in fact, like this is like the famous argument that Keynes made against the gold standard was like, there's no reason that we should go back to the previous parity. Now, there actually is a reason that you would go back to the previous parity. The reason that states did this is like they wouldn't be able to borrow money or print money unless they had this commitment to undo it, right? Like if you're just coming out and promising to debase your currency, like no one's going to want to hold it, right? And then you're going to be, and so you can print as much as you want, but it's relatively worthless. You're not going to get much for it, right? So they actually had to have that commitment. But the thing is that meant that you would have to have a deflation, and these deflations were always pretty costly. But what happened, in the interwar period is that you had a massive increase in the demand for gold as people were resuming the gold standard at a time when you already needed deflation to return to those previous parities. So you already had like a necessary deflation that had to occur, but then on top of that, people's increase in the demand for gold is going up, which is going to further put deflationary pressure on things, because by definition, the nominal price of gold is fixed under a gold standard. So in order for the price of gold to go up, all other prices have to go down, right? And so what happened is that because the United States actually had accumulated so much gold during World War I, whether they did this deliberately or not, I think they did do it deliberately, is that they were essentially allowing gold to kind of flow out of the United States to kind of ease that demand. So if the demand everywhere else is going up, if the United States allows gold to flow out, that's a decrease in their demand for gold. So that should that should relieve some of that pressure. And so that actually, was pretty successful until you started getting into the late 1920s. And as you started getting into the late 1920s, the United States was looking around and going, hey, like our stock market's getting pretty crazy. And they interpreted the run up in stock prices to speculation. They were like, oh, like we're allowing gold to flow out, which means our interest rates are too low. But because interest rates are low, this is stimulating a bunch of investment. And so but that's, but that investment shouldn't be going on. Like people are just, people are just taking much more risk because they can borrow at much lower rates. So they started getting really concerned about this. And so they started really focusing on domestic concerns rather than these gold flow issues. But an argument that you could make actually is that investors were anticipating that deflation was coming. And so that was actually keeping stock prices low. But as time went on and the deflation wasn't coming, investors started getting more and more confident that like, hey, maybe we're actually going to avoid this. Maybe like central banks have figured this out and they're all going to coordinate their activity and like we're not going to experience this deflation. And then that is sort of what led to stock prices to start accelerating over time because they were sort of undervaluing companies in the expectation of this post-war deflation that just never came. And evidence that this might be the correct interpretation is actually that the United States stock market crashes after the United States essentially came out and said, we're not going to lower our interest rates. So the UK had been artificially lowering its interest rates to allow gold to flow out because the United States had raised its rates. Well, when the UK said, "Hey, we're not going to do this anymore. We're not going to let any more gold flow out. We're going to start raising rates." The expectation is that, well, the US would just take over, like they would go back and take over that role. And they basically came out and said, "No, we're not going to do that." And within a couple of weeks, like the stock market in the United States just crashed. And so one argument that you could have is that people realized, like, oh, the United States is serious. And so given that they're serious about this, deflation is coming. And so so that was sort of the canary in the coal mine to tell you inflation was coming. But the long and short of this is really that, like, the deflation was policy induced. These were policy choices made by the governments around the world. And you can argue that they had no other choice because this is how they financed wars. But it was policy induced. And there seems to be this idea that, like, there's a really weird idea in central banking, right? Where central bankers see themselves fighting inflation and fighting deflation, when they don't seem to realize that they're the ones who create inflation, or they're the ones who create deflation. Like that's them, right? And so they're not inflation fighters. And they're not deflation fighters, right? They're inflation creators. They're deflation creators. This is what they do. And but they sort of, the way that they talk is they sort of put themselves like sort of external to the actual situation. Like things are just happening to the economy and they're responding to them, when they're actually a major, significant, big player in the economy itself. And so I think that fundamentally they just drew the complete wrong lesson from this time period. And because they drew that wrong lesson from this time period, they're obsessively, opposed to any kind of deflation anywhere, without any recognition that actually, like, their policies are the sorts of things that create deflation that cause the problems in the first place. It's not just typical ordinary deflation that would be caused by technological progress.
This is helping me understand that a lot. And if I were to just point back onto that example of the Great Depression, so we're saying that the stock prices kind of should have been falling, or at least in some relative sense, because all prices should have been falling a bit because there was a deflation overall that needed to happen. So do you think was there a policy issue from that point? Like, what is did the stock market price falls have to lead to a whole economic catastrophe? Or, like, tell me a bit more about.
So I don't think that I wouldn't interpret what happened in the stock market as the cause of the Great Depression. I would actually just interpret it as a recognition that that's what was about to happen. And so the stock prices were because if you look at actually what goes on, is that this was entirely a gold standard issue. If you want to know the single greatest predictor of recovery, from when the recovery from the Great Depression began in every single country in the Western world, it's when they either left the gold standard or devalued their currency in terms of gold. For every single country, when they left the gold standard, their recovery started immediately. Because what was happening is you just had this excess demand for gold around the world by all of these central banks. And so when you've got that excess demand for gold, the only thing that's going to solve that is deflation. And so the only way you could escape this deflation is to actually just leave the gold standard, or to just devalue, the dollar or the pound or whatever in terms of gold, because in that case you would induce like a domestic inflation, because now all of a sudden your currency is worth less. But that's the point, is that the recovery didn't start until people left the gold standard. And so it's this excess demand for gold that has to explain what the cause of the Great Depression. And it's really the resulting deflation that's the cause, right? Like because people had come to expect that the deflation wasn't coming. So people were making they were engaging in debt contracts based on the expectation that deflation wasn't going to happen anymore. So when the deflation occurs, now it's an unexpected deflation. And if it's an unexpected deflation, well, now all of a sudden, like, you're in way more debt than you anticipated before. And this is one of the reasons why, like, in the United States, there's so many bank failures and things like that, because this deflation was wreaking havoc on people's ability to pay back the debt. But it was entirely driven by policy decisions on the part of central banks. And central banks actually knew this, right? Like, they were meeting with one another in the 1920s talking about, hey, maybe we need to coordinate our on how we manage gold reserves around the world, because if we don't coordinate, if we're all trying to accumulate gold at the same time, this is actually going to be really, really bad. And I mean, they were talking about this in the 1920s, so they knew that this was a problem. The issue is that modern economists who don't study history, just have never learned this lesson. They learn really, really lame explanations for the Great Depression, right? Like, it's just like, oh, it's like overconsumption. It's like the failure of capitalism. It's just like a problem of deflation, without actually wondering where this deflation came from, right? It was a policy-induced deflation caused by these central banks, and that's I think like the definitive evidence for that is the fact that countries that recovered all started recovering when they left the gold standard or devalued their currency in terms of gold. And so I think that's fairly strong evidence that it was, the mismanagement of the international gold standard that actually caused the Great Depression, not some inherent flaw of capitalism, not some random deflation that just dropped from heaven or something like that. Like, this is, these were deliberate policy decisions and deliberate and policy mistakes.
And to see if I understand this, so because we have this deflation, but I'm wondering, why does real output have to fall, and why does everything actually, like, people stop producing as much, stop consuming as much? You talked about there was like expected deflation, expected inflation was weird, so people borrowed too much. So I mean, I'm just wondering, do you think, even if you had to have had the war, do you think that afterwards we could have got to the gold standard again at the right parity, so that it works, so that you can have that maintenance of trust of it, and just had deflation without like a Great Depression type deal?
Well, it's not actually clear, because like, this is the culmination of a very, very long process. So like, the idea that you would suspend the gold standard during a war, this is like a British invention, right? Like, the British, I don't think they did it on purpose initially. I think it was just kind of like done out of necessity, sort of during like the French Revolutionary and Napoleonic Wars. But what they realized is that it was incredibly effective. Now, it was incredibly effective for them at financing the war, right? It was incredibly costly to people, in the sense that during the war, you had this dramatic inflation. And then after the war, you had, when Napoleon is defeated, you have this dramatic deflation that occurs, and pretty rapid deflation, which was very costly to the British economy. But one of the things about this is that until World War One, this it's the scale of the war that seems to really matter here, right? Because yes, the British economy kind of suffered after defeating Napoleon, but that was short term, and it was only the British economy, and it didn't affect the larger gold standard, in general. Like, countries that were using gold, really didn't experience dramatic effects here. It's kind of the scale of the war, the fact that it's World War One, right, and everybody is kind of engaging in this activity. The issue is, it's not clear to me that this was avoidable if you wanted to go back to the previous parity. But at the same time, they were kind of stuck going back to the previous parity, because if they didn't go back to the previous parity, if the next time that you went to war, that tool probably would be unavailable to you, because people would remember that, oh, hey, the last time we went to war, they suspended the gold standard, and then all of my and then all of my pounds or all of my dollars were worth substantially less after the war. So that didn't work out for me. And so in that case, you would likely get citizens, rapidly selling their pounds and dollars for gold and trying to hoard gold, and during the war itself, which would hinder the ability for these countries to finance it. So I don't know that they had another choice than to do that. I also don't know that it could have been avoided. It's possible that coordination between central banks could have avoided it, or could have or could have, sort of made it less severe, or sort of drug it out a little bit longer, or something like that, or sort of minimize the damage of this kind of policy. But fundamentally, the problem isn't just that we went back to the gold standard. Fundamentally, what it was about is that all of these central banks, like the French and the United States, are the most notable examples, who kind of just prioritized what was going on in their own countries above and beyond what was going on internationally. And the issue there is that when you prioritize those domestic concerns, you're doing so at the expense of the operation of an international monetary system. And so, you should expect there to be breakdowns in that system. And so, on the one hand, you might say, hey, look, this was inevitable because of these policies. But on the other hand, it's not clear that it required the Great Depression. And it's not clear that policymakers deserve to skirt the blame because those policymakers deliberately prioritize domestic concerns over international concerns, and that's largely what what led to the breakdown of cooperation and the deflation that we subsequently saw.
It seems, tell me if you disagree with this, that if you are going to have wars and then you need financing, so then you might want to break things like gold standards. And so unless you're gonna allow your own economy to suffer gigantic costs when you try and get back to a global parity with the gold standard, you can't really. I mean, I'm just wondering, because the gold standard eventually we left it, and do you think that, like, in part as through wars or in general, do you think that shows the gold standard couldn't work and would be unstable?
So I have a very, very long paper about this called the Treasury Standard. And basically what I argue is that when we think about the state's role in money, the state's role in money is primarily driven by their ability to finance large-scale emergencies like war. And I think if you look at how the financial system evolved, the Bretton Woods system is a deliberate attempt to deal with this problem. So what they tried to do is they tried to say, okay, hey guys, look, we're going to kind of go back to the gold standard, but we're going to create this system where gold and dollars are basically perfect substitutes. And the idea there is that if you ever got into this situation again, there wouldn't have to be a scramble for gold because there could be a scramble for gold and dollars. And because you can create dollars, this wouldn't be an issue, right? Because if there's a scramble for dollars, we don't have to have the deflation because we can just print a bunch of dollars and you can hold those dollars. And so that will relieve some of the pressure.
So before gold and dollars weren't perfect substitutes, what were they?
Well, I mean, they were, but the Bretton Woods system was set up so that the dollar would be redeemable for gold by foreign central banks. And then all of the other participant countries would then just have a fixed exchange rate with the dollar. And so the basic idea was to get foreign central banks to hold dollars and gold in reserve rather than just gold. And what that would do is relieve some of the deflationary pressure on gold from events like wars and things like that. And so the basic idea is like, well, what you're doing is you're making gold and dollars perfect substitutes as reserves at foreign central banks. The problem is you can't legislate perfect substitution, right? Perfect substitution is an economic outcome. It's not a legal outcome. So kind of the issue here is that system also started breaking down because what you saw is that in the post-war period, the United States is spending a bunch of money rebuilding Germany, like rebuilding Japan, getting involved in foreign conflicts around the world, ostensibly to fight communism, right? And so, but what this was doing is it was leading to a dramatic flow of dollars out of the United States to the rest of the world. And so foreign central banks started to accumulate more and more dollars. And as they accumulated more and more dollars, those foreign central banks started to become concerned that, like, hey, is the United States actually going to be able to redeem these dollars for gold? And so some countries like the French started pressuring the United States to actually redeem dollars for gold. Other countries just started sort of complaining about these kinds of things. Speculators in the gold market started essentially making a bet that the dollar would have to be devalued and things like that. And so the system ultimately broke down because you can't legislate perfect substitutability. But the thing is that the United States really, what the United States really did, and this is consistent, from the Nixon administration to the Ford administration to the Carter administration, and onwards, is that with the breakdown of Bretton Woods, the United States really pushed to just make U.S. Treasury bonds the new reserve asset of the world rather than gold. And this actually started this actually started prior to. I mean, this was going on as far back as John F. Kennedy was like sort of telling people, hey, look, if you don't want to hold these dollars, just buy our bonds, right? And because they earn interest, and so that'll be even better than gold, right? Because you're going to earn a rate of return. And so the United States engaged in deliberate policy activity designed to get the U.S. Treasury bond to replace gold as that global reserve asset. And I think that you can trace this to their need for emergency finance, right? Excuse me. Fighting all of these wars, spending all of this money abroad was unsustainable under the Bretton Woods system. And so they had to find a system in which it was sustainable. And so if everybody is willing to hold your debt instrument as their reserve asset, well, then you can potentially run up a lot of debt, right? As long as these countries are growing, their demand for reserves will be growing. And so the more debt that you create, you'll have this passive demand waiting for that debt.
So that would be very convenient to have your own currency and debt be the reserve standard for the world. But am I right in understanding the way it broke down in the 70s was countries going like, hey, this dollar equals gold that you've just imposed on us. I want the gold, and sort of just, and then it kind of collapses as people want more gold and not dollars.
Yeah, as dollars are flowing out, you just had people started selling their dollars for, the West German mark. You had them. You had speculators that were just speculating on the price of gold, because the dollar price of gold was set at $35 an ounce, and people were just betting that like they're not gonna be able to do that. So you had people just going out and actually bidding up the price of gold in the expectation that the United States would have to devalue if they wanted to continue operating as is. And so you had this pressure on gold, which is a problem, right? Because when the price of gold in the market is $41, say, but it's only redeemable for $35, well, then you might want to sell it on the market, right? And make a profit. But if you're not selling it on the market to make a profit, that's because you must expect that like it's actually going to be worth more in the future if you just wait, right? So I think that the situation, it broke down because it was just sort of unsustainable. They tried to create the system in which people would just hold dollars or gold, but people's willingness to hold dollars depends on U.S. domestic policy and the belief that the United States can actually make good on its promise to redeem these dollars for gold. And as people lost confidence that the U.S. would be able to do that, that started putting pressure on the gold price. It started putting pressure on the United States to do something. And so, the Nixon administration, technically they didn't leave the gold standard. They suspended the gold standard. So we're still just waiting for the United States to announce the return.
Right.
But actually, if you go back and you read, accounts of what was happening in interviews with people who were part of the decision, a lot of them were actually arguing that that the suspension, that the temporary suspension of the gold window was designed to actually just bring Europeans to the table and get them to negotiate a sort of settlement. And then that sort of just never occurred. And so we just never returned to gold. And in fact, policymakers in the United States actually very, very quickly pivoted away from that strategy. When it became clear early on that like there wasn't going to be any kind of negotiation here, because what they wanted all of these European countries to do is to do one of two things, which was either to appreciate their currency relative to the dollar, or they wanted them to just actually like take some of the dollars and invest them in U.S. Treasury bonds. And the argument was, hey, we're providing defense all around the world to you Europeans, and so like you guys should actually just budget some of that yourselves by buying our bonds, and so that's your way of sort of paying for some of this defense. Now, whatever you think about the merits of that, this very, very quickly, it became clear that like these were significant challenges, and because you had these significant challenges, they move very, very quickly to make the Treasury security the new global reserve asset. And in fact, I mean, one of the things that people kind of miss out on this is that, the sort of oil shock of the 1970s was actually a response to what these oil producing countries saw as a devaluation of the dollar, which was going to harm them since they priced their oil in dollars. But again, we now know this, which, there were rumors of this at the time, but we now know this because there's been reporting and things have been declassified and things like that the United States actually was sending people over to Saudi Arabia and like saying, hey, we need you to keep pricing oil in dollars, and like we'll provide you with with weapons, and we'll provide you with defense, and we'll be your ally as long as you keep these things in terms of dollars. And oh, by the way, we want you to take the excess dollars that you're bringing in, and we want you to invest them in U.S. Treasuries. And the Saudis were sort of skeptical about this because the Saudis were worried that the United States, is an ally with Israel, and they were worried that, hey, we can't be seen buying your bonds because our allies are going to say, hey, you're effectively funding U.S. support of Israel. And so the United States and the Saudis actually reached an agreement where the United States would just sell these treasuries to the Saudis outside of the formal auction process, which meant that they could keep those things secret from the rest of the world. And so, the idea that we have the current monetary system because this is just kind of path dependence, which is the story that you often get told, is just wrong, right? Like these are deliberate policy decisions that were designed to keep the system in the way that it is, because that system benefits the United States and allows them to conduct a lot of this emergency finance. And so if you think that, what the U.S. is doing around the world is really good, then you think this is a really good thing. If you think what the U.S. is doing around the world is really bad, then you probably think this is a pretty nefarious scheme. But regardless of whether you think it's a good or a bad thing, like I don't think anybody can argue that that this is just path dependence. This is deliberate policy actions on the part of the United States to maintain that ability to do emergency finance, and by basically just making their debt instrument the reserve asset of the rest of the world.
It's some ways seems that the US can kind of claim, hey, we're a huge superpower, we can protect your countries if you buy into this system rather than gold. And then I'm thinking about Bitcoin and the degree to which if you have something, this money which no centralized person kind of has, the kind of what that does to the, like, now that it exists, we talked at the start about, we have these innovations, we'll see what the market prices it at. And then do you think that, I don't know, it kind of has an alternative thing you can put your money into that I can have value in this decentralized way? Does that change incentives for, I don't know, because I mean, instead of, the Saudis are, well, the US treasuries are pretty, valuable if we think that the US is a powerful country. And so does it kind of change incentives around the world for, say, things like wars? We talked about incentives to get off the gold standard, to have, the borrowing and money.
Yeah, so I mean, I'm really skeptical. Like, there are a lot of people who are advocates for Bitcoin who are very sort of like, hey, Bitcoin's going to end the wars, and like, I just don't. I just don't buy that. Governments around the world have been figuring out ways to finance wars. During times of commodity money, and I don't see how that would be different with Bitcoin. So I don't really buy the argument that it's going to end wars or what have you. To me, I guess there's sort of two levels to think about this. One is sort of on an individual level, and one is sort of on a geopolitical level. So on the individual level, I think that the presence of Bitcoin is an important check on, or at least it can be an important check on the United States government, right? So if you have a sense that they're running up too much debt, this is a sort of release valve, right? Like, you can hold Bitcoin and it's in fixed supply. So that, if you're concerned about the debt, if you're concerned that it's going to be inflated away, well, then in dollar terms, like your Bitcoin should go up in the event that inflation occurs. And maybe it'll just be enough to offset the inflation, or maybe it'll actually go up, by more than that. But regardless, it potentially provides you with some insurance against that sort of thing. And in fact, like if you talk to people who work in finance who have become kind of increasingly interested in Bitcoin, like there are people who kind of refer to Bitcoin as like equivalent to kind of like a credit default swap on sovereign debt, right? That when sovereign debt levels get too high, then Bitcoin will go up in terms of the domestic currency, and so that's insulating you from that problem. But even more simply, on an individual basis, it just gives you the opportunity to sort of opt out, to have to not have some of your savings or some of the money that you're using, eaten away by inflation and things like that. And so now, of course, for that to really be an effective strategy, without having to go back and forth between Bitcoin and dollars, you either would have to have a situation where the United States got rid of, say, capital gains taxes on Bitcoin, or you have to have a situation in which transactions in Bitcoin aren't subject to those kinds of taxation. And so, then people could actually develop an economy where people are willing to accept Bitcoin in transactions. On a geopolitical level, I actually think that like that something like Bitcoin is important and something like gold is important. And I think because the United States finds itself in a precarious situation. This Treasury standard that they've created, if you think about it, as the global economy grows, the demand for reserves grows. Well, those reserves are the U.S. debt instrument, right? The U.S. government debt instrument, which means that in order to meet that increased demand, the United States has to borrow more, right? And the problem with this is that there's some level of borrowing, at which point people start to think, hey, you know what? I don't think that they can actually pay this back, or like actually we're spending like the vast majority of our budget on like interest payments, and so like that's not sustainable. And so if you get concerned about that sort of thing, like that could actually unwind the entire system. And the problem is that the United States finds itself in a really difficult spot, because on the one hand, they have to recognize that there is this instability that's created by this ever-growing government debt. At the same time, they don't want to give up the power that they have to another sovereign country, right? They're very, very worried if, like, the Treasury securities stop being the reserve asset. Well, what's going to replace it, right? Is it going to be, is it going to be something issued by like the Chinese or something like that, right? Like this is one of the things that they're concerned about. And so I think that actually, like the way to think about this is that there's actually a third alternative, and the third alternative is that maybe like what you want is at least some component of reserve assets in the world to just be neutral assets, right? And so gold is a neutral asset. There's no single country that's able to produce more, that's able to control the supply of gold, right? And so that's a neutral asset. It doesn't belong to any particular sovereign. And the United States would be much better off, if foreign central banks substituted treasuries for gold than if they substituted treasuries for some Chinese asset. But Bitcoin is the same thing, right? Bitcoin is also a neutral asset, right? So nobody controls the supply. The supply is controlled by the code. So nobody can manipulate the supply. And so you would be better off if central banks, who are thinking about, not holding treasuries, you would be much better off if they replace those treasuries with something like Bitcoin than if they replaced it with something like some other sovereign asset. And so when you get into those kinds of situations, you realize that maybe actually the United States should be promoting things like gold and Bitcoin as an alternative to some other sovereign nation taking over this power that gives you, dramatic control over geopolitical forces throughout the world.
Right. So, I mean, yeah, it doesn't necessarily, yes, end wars in some magical fashion, but there's in some way at the margin where you have some asset where you, like, it puts almost, would you say, like, it limits a bit the amount of borrowing capacity of a country like the US, and it also maybe, in some ways, if it's interesting if the US actually in some ways has an incentive to people to get Bitcoin and over some other country's reserve asset. It's like it's supporting this neutral thing, and like, yeah, interesting. So just to clarify one thing, do you think that business cycles we talked about, like, do you think they're policy induced, or are they natural things like, as you talked about central bank and what we have to come in and fix these issues, what's going on, as if they're an outside agent. What is your take on that in general?
I mean, I think that, yeah, I mean, business cycles, um, I don't think that they're all policy induced, but I think if you look at the most significant business cycles that we've experienced, certainly over the last century, I think that you can argue that those major like recessions were policy induced, either because they were caused by policy or they were caused by a poor response of policy to what was going on while it was going on. And so, in a lot of cases, they might have taken like a minor recession and made it much more severe through their policy mistakes. And so I think that I wouldn't say that they're all policy induced. I mean, people were talking about business cycles long before, there was, coordinated monetary and fiscal policy that was going on. So, I mean, clearly there are sort of just natural kind of fluctuations that occur in economies. But again, I think part of the hubris of the modern economics profession is this idea that we can sort of smooth all those things out, that we can kind of remove the business cycle as a concern. And I'm not convinced that that's the case. I mean, I think that we can probably make a difference at the margin, but the historical experience is that there's a difference between theory and practice. And so in theory, we can stop a lot of these things at the margin, but in practice, do we? And I think like a lot of the evidence suggests that oftentimes we make things worse.
What is the future of your work? I mean, are you able to write papers on Bitcoin? Like, what are you thinking about?
I mean, I'm writing about a whole bunch of different things, I guess. Like, so Bitcoin is always kind of on my mind. I typically write papers about like political economy of Bitcoin. So the sort of politics involved, how states respond to this kind of stuff. I'm also working on a much larger project, which is the Treasury standard is only a sort of part of, where I try to look at the role of national defense in sort of the development of the state, and then like why we have particular institutions that we have, and why governments design them the way that they do. I think that I mean, as you can probably imagine from this conversation, I'm a pretty like pro-market guy, but also at the same time, I really want to try to understand, why governments do what they do, and just understand them as is, not without any sort of normative lens cast on what they're doing. Is just sort of like so, for example, if you have a policy that lasts for like 100 years, and a bunch of academics are telling you that policy is terrible. I don't know. Actually, I think that maybe we want to take like a little bit deeper look at that and kind of figure out, like, if it's so terrible, how has it lasted 100 years? Like, what was it designed to accomplish? Because, like, I mean, one of the things is like, if you think about, I mean, if I hire, like, here's the way to think about it. If I hire somebody to like stand outside my house and guard it at night, and no one ever tries to break into my house, well, I could conclude that I just wasted all of that money because no one ever broke in, and I just paid this guy to stand out there, every single night, holding a weapon, and like, and he never had to do anything. And so I could easily conclude that, like, hey, that was pointless. But there's also, you could also make the argument that maybe the reason why no one tried to break into my house is there was a guy standing there with a gun the whole time, protecting the entrance. So, and so that's one of the things I'm really interested in, is actually understanding like what the state is trying to do and why certain policies and institutions are so durable, when a lot of academics and quote unquote experts seem to think that they're wrong. And so I'm working on this big project that's basically just about sort of national defense and trying to think about the evolution of state institutions, given the constraints that, like, the sort of primary role of the state, going back to like the foundation of the modern state, was just to like protect, the citizens from foreign adversaries. And so if you just start with that as the main constraint, how do you develop institutions? How do you develop policies? And so I think that takes you in a variety of different directions, because then you have to start thinking about institutions, you have to start thinking about taxation, you have to start thinking about the monetary system, and then that potentially leads you back to things like Bitcoin and gold and all of these kinds of things.
Yeah, I actually talked to the economist David Friedman. He's kind of he would call himself an anarchist economist, and he kind of thinks national defense is the only thing that you need a government for. He doesn't, or at least he sees that as the only thing. Like, I don't know how to replace a government in that role. And anything you kind of produce like above and beyond is kind of, you basically end up reproducing the government. I don't know.
Well, and he actually has a really great old paper on that topic, which is just like where he argues that sort of economic reasoning can help you explain like where you draw the borders for states, and it's basically about that national defense problem. Is that you have to defend this territory, but there's sort of like diminishing returns to defending your territory, and so if you and so if you take seriously those diminishing returns, you should actually be able to predict, sort of like the size of states just from those various kind of constraints that they face.
Interesting. Yeah, we mentioned that as one of his. I don't know. It's an interesting paper like that. You can apply economic theory and think about that. And yeah. Well, this has been a really fantastic conversation. I appreciate you coming back on. So anyway, you want to point you to? I know you have that Substack. Tell me about that.
Yeah, so my friend Brian and I, we have a Substack called Economic Forces. Essentially, what it is we just kind of talk about economics from the perspective of price theory. So we're kind of focused on things like supply and demand, that kind of stuff, and just how far that kind of analysis can take you, all of the various different ways that you can go. So every Thursday that hits your inbox. It's free. I mean, you can give us money if you want to. We appreciate donations, but I mean, you can also sign up for free. That's probably the best. That's probably the best place to reach me, I guess, is through there. That's probably where I'm having sort of much more serious conversations, I guess, and engaging with these ideas.
Great, and you can let me know if there's any other links. Cool. Thank you.
No problem.